Imagine walking into a bank tomorrow morning, you ask for a home loan, the banker checks your salary, looks at your credit score, types a few things into a computer, and then says, "Congratulations. We've approved your loan." A week later, $100,000 appears in your account. Simple, but here's the question almost nobody asks: where did that $100,000 actually come from? Not where it was transferred from, not which account it passed through, where did it originate? Most people imagine there's a giant vault somewhere, rows of cash, stacks of money waiting to be lent out. Someone deposits money, the bank lends that same money to someone else, a simple middleman. That's the story. It's also not how modern banking works. In fact, if you understand what is about to happen in this video, you'll realize something deeply strange about the financial system. Most of the money you use every day was created out of debt, not mined, not printed, not earned first, created. And once you see how it works, it's difficult to look at money the same way again, because the question isn't where bank money comes from, the question is why we're comfortable with the answer. To understand this, we need to travel back a few centuries. Imagine you're a goldsmith, people trust you, they leave their gold with you because your vault is safer than their homes. In return, you give them receipts, pieces of paper proving ownership. Over time something interesting happens, people stop carrying gold, instead they trade the receipts. Why move heavy metal around when the paper represents the same thing? The receipts become money, and eventually the goldsmith notices something: almost nobody comes back for all their gold at the same time, most of it just sits there, unused. So the goldsmith starts lending some of it out, carefully at first, then more aggressively, and for a while everything works. The depositors believe their gold is available. The borrowers spend newly created credit, the economy grows, everyone seems happy, until too many people ask for their gold back at once, then the illusion breaks. This was the early ancestor of modern banking, but today's system goes much further, because modern banks discovered something even more powerful: they don't always need the original deposit first. Let's say you walk into a bank asking for a $500,000 mortgage. What most people imagine is this: somewhere inside the bank, another customer deposited $500,000, the bank takes that money and lends it to you. One person's savings become another person's loan. Logical, intuitive, wrong. What actually happens is much stranger. The bank approves your mortgage, then it creates a deposit in your account. The loan becomes an asset on the bank's books, the deposit becomes a liability. Two entries appear: one loan, one deposit. And just like that, new money exists. No pile of cash moved, no saver necessarily funded it, no vault became emptier, a balance sheet expanded. That's it. This sounds absurd because we're taught to think of money as a physical thing, but in modern economies, most money is simply accounting entries, numbers in databases, digital claims, promises. According to many central banks, commercial banks create the majority of money in circulation when they issue loans, not governments, not printing presses, banks. This means that every time a large loan is created, new money can enter the economy, and every time debt is repaid, money can disappear. Think about how strange that is. We usually imagine money and debt as opposites, but in modern banking they're often born together: no debt, no new money, which raises an uncomfortable question: if money comes from debt, what happens when everyone wants less debt? We'll come back to that, because first we need to understand why this system exists at all. At first glance it sounds dangerous, maybe even ridiculous. Why allow banks to create money? The answer is economic growth. Imagine an economy where banks could only lend existing savings. Every loan would require someone else to stop spending, investment would move much slower, businesses would struggle to expand, homeownership would become harder, economic growth would often be constrained by existing cash. Credit creation changes that. It allows future productivity to be pulled into the present. A business can borrow today to build a factory, a family can buy a home decades before saving the full amount, an entrepreneur can hire workers before profits exist. The system accelerates growth, and for long periods, it works remarkably well. That's why nearly every advanced economy uses some version of it, but every strength comes with a weakness, and this is where the story becomes interesting. Imagine banks become optimistic, very optimistic, they approve more mortgages, more business loans, more credit cards, more commercial real estate deals. Each loan creates more money. More money means more spending pushes up asset prices, rising prices make people feel richer, feeling richer encourages more borrowing creates even more money, the cycle feeds itself. It feels like prosperity, sometimes it is, sometimes it's a bubble, and the difference is often only obvious in hindsight. Look at housing markets throughout history, prices rise, banks lend more, people rush in fearing they'll miss out, credit expands, optimism spreads, then something changes, interest rates rise, borrowers struggle, defaults increase, credit slows, money creation weakens, asset prices fall, and suddenly everyone discovers that growth powered by debt can reverse direction. The global financial crisis of 2008 exposed this reality in dramatic fashion. For years, credit expanded aggressively, housing prices surged, debt piled higher. Then confidence cracked, what seemed like wealth suddenly looked fragile, because much of the system depended on continued borrowing, continued lending, continued belief. When those things disappeared, panic followed, governments intervened, central banks intervened, trillions were mobilized to stabilize the system, not because money itself vanished, but because confidence did. And confidence is the invisible foundation underneath every monetary system. This brings us to another misunderstanding. Many people think central banks print all the money. The reality is more nuanced. Physical cash represents only a small fraction of modern money. Most transactions happen electronically, most money exists digitally. Central banks influence the system, they set interest rates, provide reserves, act as lenders of last resort. But commercial banks play a massive role in creating the money people actually use. It's a partnership of sorts, a complicated one, sometimes cooperative, sometimes tense, always important. Now here's where things become even stranger. Suppose every borrower in the country somehow paid back every loan tomorrow, every mortgage, every business loan, every credit card balance, everything. At first that sounds wonderful, a debt-free society. But under the current system, a huge amount of money would disappear alongside the debt, because much of the money was created when those loans were issued. Repayment destroys those deposits, the money supply contracts, economic activity could collapse. The irony is almost comical. The system depends on debt, it constantly warns about excessive debt, it encourages borrowing, yet fears over-borrowing. It creates money through credit, then worries about credit growth. It's a balancing act with no permanent solution, only management, and that's what makes modern banking so fascinating. It's not a machine, it's an ecosystem, built on incentives, expectations, confidence, and human behavior. The mathematics matter, but psychology matters just as much, because banks don't create value by typing numbers into computers. The numbers only work because society collectively accepts them. The mortgage works because builders build homes, businesses produce goods, workers create services, governments enforce contracts, courts protect ownership, people trust the system enough to participate. Take away the trust and the numbers become meaningless, which leads us back to the original question, where does bank money come from if nobody deposited it first? The uncomfortable answer is that much of it comes into existence when banks create loans, a new asset, a new liability, a new deposit, new money, not magic, not fraud, not printing presses running in secret, just a system designed to transform future promises into present purchasing power. And perhaps that's the strangest part of all, the dollars in your account, the money used to buy homes, build companies, fund governments, and shape entire economies, may have started life as nothing more than someone's promise to repay, which leaves one final question: if the money system is ultimately built on debt, confidence, and future expectations, what happens when the future stops looking better than the present? Comment in below section.